Good morning, students. Welcome back to the session on audit. So today we are going to continue our discussion on tax audit. In the last session, we discussed some of the requirements related to audit reporting when it comes to the tax audit. Then we also discussed certain clauses of tax audit in terms of the Form 3CD, which is required to be covered by the management and which is then required to be audited by the auditor. So today we plan to continue with our discussion and we'll move further to some more particulars of this Form 3CD. And we'll also get into certain illustrations or these questions to practice all of these points. So quickly talking about the tax audit, in terms of the tax audit, uh, one point was about the audit report, wherein we discussed that Form 3CA is required to be issued by the auditor when the audit is required to be covered under any other law, means other than Income Tax Act, and Form 3CB will be issued in every other situation, means wherever Form 3CA is not applicable, Form 3CB will be required to be issued by the auditor. Then comes the requirement of Form 3CD. Form 3CD is the form which is filled in respect of various particulars of the company or the entity which is subject to tax audit. And all of this information which gets filled in Form 3CD helps the department in terms of checking various transactions which would be in the nature of reconciliation from what is shown in the books of accounts as the profit and what is shown in the income tax return as the taxable income or as the loss. So this reconciliation which covers various aspects, this is one. Secondly, as regards the information which is going into the financial statements, some of those points are also incorporated in this Form 3CD for the purposes of their detailed evaluation by the department. And that's why whenever income tax return is submitted and in respect of those assessees for whom the tax audit is mandatory, so that's why in such a situation it's mandatory to put this income tax return along with the Form 3CD or this tax audit set, which is comprising of Form 3CD and the audit report on this, financial statements and the audit report on the financial statements, and then the ITR. So it's a complete package which is then looked at by the department. Now moving further on to the next clause, clause number 16. It requires auditor to check the amounts which are not credited to the statement of P&L, means amounts which are not taken to P&L, being the items falling within the scope of Section 28, the pro forma credits, duty drawbacks, refund of duty of customs or excise or service tax, or refund of sales tax or value-added tax, where such credits, drawbacks or refunds are admitted as due by the authorities concerned. Escalation claims accepted during the previous year, any other item of income, or if there is any capital receipt. Now, let's try to think about it, that there is a receipt which is falling under any of these sub-clauses, means A, B, C, D, and E, but for some reason that is not taken to the P&L. For example, maybe there is a drawback, or maybe there is a refund of duty, or maybe there is refund of any sort of taxation, which instead of taking to P&L, entity may have adjusted with the amount of, say, fixed assets. Okay. Now, the moment this is adjusted with the amount of fixed assets, its impact doesn't get reflected in the P&L. But for the purposes of department, what do they need? They need such income, let's suppose, to become taxable. So this form or this particular clause therefore will help them to track it. Similarly, if there is any other income which is falling under any of these clauses, and which may again have been adjusted by the assessee, say with any of the assets. All of those assets have got adjusted with this. There again, those particulars are required to be captured over here. Now, in respect of this, let's think about the audit procedures. What can the auditor do? First thing will be to check the nature of transactions which will fall under this category, and then to evaluate them from the books of accounts of the companies, means get into the ledgers of all of these items and to check what all are the amounts which have been recorded under those ledgers during the course of the year. And all of those amounts should be reflected over here. If any of them have not been routed through P&Ls, that means the next check will be not only to get into those ledgers or the books of accounts, but also to trace them to the P&L. If those are already taken to the P&L, then those will not appear over here. But if those are not taken to the P&L, then those are required to be recorded over here. It may happen that there is a refund or duty drawback or something of this nature as per point number B, which has been admitted as due by the department, by the authority, means by the relevant department from which that refund has been claimed. Many a times, assessees do not record that as income or do not take it to P&L till the time it is not actually received. Now, in such a case, what are we required to do? We are required to check what has been the transaction of the company against which such type of claim may get in respect of which any of the claims may be made by the assessee. If the claim can be made by the assessee towards the relevant authority, then there could be various stages around it. First stage could be the one wherein the company has evaluated as per the scheme. Let's suppose there is a drawback scheme which allows any drawback. Now, in respect of that drawback, first of all, the assessee will submit the required documents to the relevant authority. So it's only the submission of the required documents. Then, as a next step, once those documents are submitted, the relevant authority may process those documents and may acknowledge that and may also come up with some queries around it, which the assessee may be required to furnish again. Once this entire process is completed, then the relevant authority may admit them. Admit means it's been accepted by them. So they have acknowledged, they have accepted, and they will get this processed for the payment or for the refund in this situation. Now, that is the stage when the refund has actually not been received, but the assessee, or for that matter, any entity, will be certain of receiving that. It may take long period of time or it may take a short period of time. So that's not the perspective we need to get into. We need to understand that that's the stage when the refund or this drawback or any of such item is refundable and it's also certain. So that is the stage when such claim is required to be captured over here. And it really doesn't matter whether that has been recorded in the books of accounts or not. Because as I told you, many a times we see entities or the assessees recording it only when it becomes, only when it is actually received. So that is again one area which may become a point of difference over here. Yeah. Moving further on to clause number 17. It says whether any land or building or both is transferred during the previous year for a consideration less than value adopted or assessed or assessable by any authority of a state government referred to in section 43CA or 50C. If yes, then the assessee requires to furnish these details. So if you can look at the details, it talks about It talks about details of property, means the address of the property. Consideration which is received or accrued, means consideration received or receivable. Value adopted or assessed or assessable. Okay. Now all of these three items are required to be captured, and let's try to understand what all details will go and how will the auditor verify this. So coming back to the requirement of the clause, it says if there is any land or building or both. So let's suppose this building that has been transferred for a consideration less than the value adopted or assessed or assessable by an authority of a state government. So let's suppose there is a building for which the value at which it should have been transferred, say, was 10 crore. Say for the building, the value was 10 crore. At which it should have been transferred. But actually, this was transferred at 9 crore. Transferred means it was sold. So that's why actual consideration was 9 crore only. Now, this is the matter which is required to be reported, because some of the requirements of these sections may require the assessee to pay tax not on this amount but on this amount. Because as per the department, if the sale would have to take place, then that should have taken place at this and not this. So in case there is any under recording of the sales consideration, that is tried to be captured over here. And we are tax auditors, so let's understand what can be the audit procedures around it. So first item will be to check if there is any deletion in the PPE schedule, because if any of these items will get transferred, then we go to the books of accounts, we look at the PPE schedule, and in the PPE schedule we'll see if there is any sale of any of the buildings or any of the land which was appearing in the opening balances during the year, or maybe if there was any purchase and sale during the year. So that is one. In respect of that sale, the next step will be to find out the sale consideration, so that can be verified with the sale documents and of course the purchase documents, the amount at which the purchase was made, sale deed or the conveyance deed or the property documents for that matter will have to be reviewed and checked by the tax auditor. Next step will be to get into this valuation, which is required as per this section of the Income Tax Act. Now this is on to the assessee. Assessee will have to make this assessment, and therefore assessee would also have done some working around it. If the value for this building should have been 10 crore as per the guidelines, or let's suppose as per the circle rate, this should have been 10 crore, then the entity or the assessee would also have this required information, which will be produced by the assessee to the tax auditor, on the basis of which tax auditor will be able to verify whether there is such instance or not. Otherwise, tax auditor can also perform some external procedures. If there is any such sale, tax auditor can also obtain such valuations from external sources. Yeah, so today there are certain websites, there are certain online portals from which this information is available. Tax auditor can also look at some external sources in respect of the valuation of that area by physically checking it, or by getting it physically checked, or getting it verified from the valuations which would have taken place near around that area wherein this land or building would have been sold by the company, and that will become the basis for the tax auditor to conclude yes, there has not been any sale which is below this prescribed amount, and if there is any, then that is required to be captured over. Okay, moving on to the next item, and I would say very important and one of the items which captures significant time during the tax audit, and that happens to be point number 18. Point number 18. Now, point number 18, if any of you would have done tax audit, they would know that this is one area which takes up significant time during tax audit. And this is all about the information related to PPE, or we can say fixed assets of the entity. So let's understand the requirement over here. What's the requirement? Devi is asking, sir, this section 28 was as per Income Tax Act? Yes. See, anywhere where you don't see any specific act, it's always Income Tax Act in this form number 3CD. Okay, because it's all about Income Tax Act. Yeah. Okay, so now moving on to this point 18. Particulars of depreciation allowable as per Income Tax Act in respect of each asset or block of assets as the case may be in the following form. So there's a prescribed format in which this information is required to be furnished. And what is this information? Information is all about depreciation. As we discussed in the last session, that depreciation as per Income Tax Act and as per the Companies Act happens to be different. They are not same because the criteria may not match. So that is always one area of reconciliation between the taxable profit and the profit as per books of accounts. And that's why this information carries a lot of significance, because this will have a direct bearing on the computation of tax for this entity. Plus, the method of computation of income tax, of depreciation as per income tax, is also different. Unlike in case of books of accounts, wherein we compute depreciation on proportionate basis, under income tax, what do? We follow the concept of block. Yeah. So within a block, all the assets will be pooled, and there again, we don't really go by the criteria of the date of purchase of the asset on which depreciation is charged on proportionate basis. Instead, it's all about categorization of those assets within that block into those assets which are purchased for more than 180 days. Means if we compare it from the reporting date, and which are purchased for less than 180 days when it is compared to the reporting date. So that's why in this particular area, lot of arithmetical computation is required to be done. And what I'll do is, now I'll take you to a particular annexure, because this is again data which will require a lot of information to be put in. So that's why it's not possible to capture it over here. But when you fill this online, so you'll have separate part to fill this information. So let's understand what all information will go over here. Okay, so it says just 1 minute. Okay, so it talks about, first of all, the nature of the asset. means the category into which those have been categorized. Then the rate of depreciation. Then opening WDV. Opening WDV. So in this particular scenario, the opening WDV was as at 1st April 2018. Yeah, because this is the form for 1890. Then the additions which would have taken place during the year. Now additions are going by the age bucket of more than 180 days and less than 180 days. Yeah, so that's why this computation of depreciation may also be different from what you see under books of accounts. And then the SEMVED or the GST which would have been adjusted. If there is any sale proceed, that is also required to be captured over here. Then the depreciation is computed using the rates and the time period, and then the closing WDV is given. Now currently that the data that you see on the screen is very small. Maybe for this particular company from which we picked this data had very small size in terms of the fixed assets. But if you look at manufacturing companies, large size companies, or the companies which are into automotive, which are capital intensive, therein this information is very bulky. It will run into many pages. So this will not really get captured on this half a page which you can see on the screen. It will run into, I think, 30 to 40 pages, or at times running into 60 to 70 pages also. And that's why it may take a lot of time to put this information on the portal also. And that's why one area which is more of clerical in nature in this part is about checking the arithmetical accuracy of all of these items. Now, how will the tax auditor perform procedures on this? First step, tax auditor will have to ensure, first step will be whether the opening WDV is traced to the last year's closing balance. So what would the tax auditor do? He would look at the form 3CD of the last year. It's not the previous year, last year. Whatever closing balance was reported over there, with that tax auditor should start. Through which he will get the comfort that yes, the opening balances are correct. Number one. Second thing will be about testing of additions. Now for this testing of addition, first point will be the completeness. To ensure that all the fixed assets additions have been captured over here, auditor will check whether these additions which are appearing in this particular part are traced to the total additions which are going in the financial statements. In the PP schedule, total additions which would have taken place during the year are reported, and those are presented separately. So the sum total of these two additions, more than 180 days and less than 180 days, should be equivalent to that total which is appearing in the financial statement. So there should not really be any gap between these two until there is some adjustment. Okay. Once this is through, then the next step will be to check the sales proceeds. Now, under this schedule, under this part, we don't show the amount which is sold off in terms of its carrying values. Means if a particular asset has been sold, then this part doesn't require its carrying amount to be shown. It requires what was the sale proceed from its sale. And that's why this value may not match with what is shown in the PPE schedule in the financial statements. But one thing which can definitely be captured over here is that all the items which were appearing as deletions in the PPE schedule in the financial statements should also have some sales consideration. So that's a check to ensure that all the items have been captured. The amount may not match, but once again, the completeness can be ensured. So this is all about getting into the completeness assertion, and all of those assertions will also be followed over here. Next step will be to check the depreciation computation. Now this is a arithmetical exercise. So this part tax auditor can perform by recomputation of depreciation or by checking the computation of the client, of the assessee, in terms of the Excel workings, etc., which would be available to him. And on the basis of his, he will get the WDV for the as at the end of the current year or the previous year. Now, in respect of this, most of the items in terms of the procedures of the auditor that we have discussed were about tracing these balances to Form 3CD or the financial statements. See, this is very helpful to the tax auditor in two situations. One wherein the tax auditor has also performed statutory audit. Because if he has performed statutory audit, he would have done a lot of testing around all of these balances on the transactions. So he can just easily trace the balances and he has got the comfort that those balances or transactions were fine. With which he can cut down on his procedures during the course of tax audit. Second situation is wherein the tax auditor has not performed the statutory audit, but the statutory audit has been performed. Even in that case, wherein the statutory audit has been performed, even though the tax auditor was not the one who performed that, still he should be looking at all of those balances or the transactions in the financial statements to ensure consistency, to ensure completeness. Though he may now want to perform some more procedures, which is still okay, and which he may have performed even when he would have performed the tax or statutory audit. Let's understand what can those procedures be. So these are not many. Let's understand what can those procedures be. So first is about the additions and second is about the deletions. Additions and deletions. One is to trace the balances, or we can say trace the amounts. In the financial statements. Second would be to perform testing of additions. So it's about substantive testing. It's about test of details. Test of details. So testing of additions and similarly testing of deletions on a sample basis. And here again on a sample basis. Yeah. Now this is the second procedure that we will perform. Now the extent of this testing, whether on addition or deletion, may be cut down by the tax auditor if he would have performed the statutory audit. Why? Because he would have also performed the testing of additions over there. It is not necessary that because the statutory auditor performed the statutory audit, therefore he will not look at the testing of additions. Because during the course of statutory audit, he would not have performed the testing of each and every addition. That must be on a sample basis. Correct? And now during the course of tax audit, he may want to look at some more samples because his perspective over here is different. Okay. So that's why we are saying that this will still be performed depending on the comfort level of the auditor. And next procedure, of course, will be to check computation of depreciation, which is completely about arithmetical computation. Now, as around additions, the testing procedures will remain same. So the auditor will look at the ledger first of all to find out all of those additions. He will select the sample. Selection of sample will again be on the basis of materiality, because materiality will also be considered by the tax auditor. It's not that he will not be considering the materiality over here, because some of the additions may be very small. You may not want to check them. Third thing will be to check the supporting documents. So supporting documents would be the invoices of the items purchased, the contracts or the quotations, etc., which the management may have taken. Similarly, for checking of deletions, auditor will look at the sales invoices or the purchase order of the customers from in respect of these deletions which the company may have done, or maybe the sales order which the company might have issued in respect of deletions of fixed assets. Here again, another important procedure will be to look at the quotations, because if certain fixed assets have been sold, then the management would have invited quotations. So without the quotations, generally the transactions would not take place, because otherwise it will be difficult to check whether the transactions are taking place at arm's length or not, and whether the deal is fair or not. Yeah, so through the quotations, tax auditor would get to understand about the sanctity of these transactions. All right, clear? So this procedure, even though it's very simple, but it requires significant efforts on the part of the auditor because of the volume which will be involved. And generally, wherever you will find capital intensive company, the volume of this particular data will be significant. And that's why a lot of time of the tax audit team will be spent on this area. Okay, clear? Okay, so then moving further. Moving further, we can also see one attachment which captures certain more details around this particular clause only. And what is this information? This is the information which captures the details of additions. Now, in the first annexure, we saw the details of fixed assets, and the additions were given in totality. Now, all of those additions on a line-by-line basis are required to be captured over here. Yeah, so you can see date of additions and put to use, gross value, when was this purchased, means whether this is falling under more than 180 days or less than 180 days. And this is the data which I mentioned will be voluminous, because if the entity would have purchased many items, then this data would be voluminous. Similarly, if you go below, there would be details of deletions to fixed assets during the year. This data would generally not be very voluminous, because it's always about additions which is found to be voluminous. Okay. Moving further on to clause number 19, 20. It requires amounts which are admissible under section 32AC, 33AB, 33ABA, 33AC, and so on, and which are debited to P&L showing the amount debited and deduction allowable under each section separately, amounts admissible as per the provisions of Income Tax Act, and also fulfills the conditions which are prescribed therein. Moving on to clause number 20 also alongside, any sum paid to an employee as bonus or commission for services rendered where such sum was otherwise payable to him as profit or dividend. Details of contributions received from employees for various funds as referred to in section 36(1)(5)(a). Now, talking about all of them, because except for this 20B, they are like more of getting into the detailed understanding of the requirements of Income Tax Act. So it says if there are any amounts which are falling under any of these sections of the Income Tax Act and which have been debited to the P&L, okay, and which have been debited to the P&L, only then those are required to be captured over here. If those are not taken to the P&L, then those are not required to be captured over here. And these are all about some of the deductions which you see under Income Tax Act. How will the auditor capture it? This is one on the basis of the understanding of the transactions which the auditor will have to see. Secondly, this will also be understood by scrutinizing the P&L of the company or the entity, because when he'll scrutinize the P&L and he'll scrutinize the expenses which would have been taken to the P&L, from there he can capture whether any of those transactions which are appearing in the expenses which are taken to the P&L, whether they get covered under any of these sections or not. And if those are covered, then specifying the section, those amounts are required to be reported over it. 20A requires employee benefits to be assessed. So this is something which can be checked by the auditor by looking at the payroll records. And here again, in respect of payroll records, it may not be easy for the tax auditor to verify the data of each and every employee. So that's why in this case, auditor will have to have discussions with the payroll team or the HR, through which he will get to understand that if there are any employees, to find out if there are any employees to whom bonus or commission is paid during the year and which has also been taken to the P&L, which was otherwise payable to him as profit or dividend. And this is again, you will not find too often. For this, auditor will also have discussions with the management, and auditor will also require a representation in respect of this matter, particularly because otherwise it may be difficult for the auditor to find out. Because for capturing this data about each and every employee and to ensure that any of the employees which was getting such amount or was getting such amount in this form and would not have been captured in form number 3CD may be difficult on the part of the tax auditor. Okay. Now moving on to 20B. So let's understand what does this 20B requires. And for this 20B, we can straight away go to this annexure number 5. So if you look at this annexure number 5, it says details of contribution received from employees for various funds which are referred to in section number 36(1). Now, what are these contributions which are received from the employees? Provident fund. For the PF, one part is contributed by the employer and other part is contributed by the employee. And this is always a part of the CTC of the company, or we can say generally a part of the CTC of the company. And how would this be captured? This would be captured by looking at, first of all, the payroll records. So the auditor will verify the payroll records. From the payroll records, auditor would get to understand from the monthly salaries what component comprises of provident fund, and from that component of provident fund what component comprises of contribution of the employer and what component comprises of contribution of the employer. Okay, so that means he will have to verify the payroll records, and in terms of verification, again he'll check it on a sample basis. He will not get it to each and every amount, but of course the monthly totals he will have to pick up. So this entire computation he will have to obtain, from which he will have to derive the total amount, and this derivation would have been done by the management also, but the auditor will have to recompute these amounts to ensure that the entire amount has been captured over here. That is one. Once this amount is captured, the next step will be to check what's the due date for payment of this contribution. The due date for payment of this contribution happens to be 15th of the following month. So that means if there is a salary pertaining to the month of April, so that means if there is salary pertaining to the month of April, then this becomes payable on May 15th. So that's the due date. Most of the times you will see that these statutory dues, these are called as statutory dues. Why? Because these are collected from the employees or contributed by the employer but paid to the relevant authority. And this relevant authority is nothing but as per the requirements of statute. So that's why it is considered to be a statutory due, for which due date is May 15th. Now this statutory due is generally paid, this amount is generally paid by the companies on time, but at times there could be delays. That's why what would the clause require? The clause requires the actual date of payment to be specified. And whenever there's a delay, that would get reflected in this annexure. Yeah, because something, let's suppose, was due on say 15th of January, but let's suppose if that is paid on 22nd of January, so it will get reflected. Okay. Now, in respect of such amounts which are paid beyond due date, interest and penalties at times are required to be paid by the company. So let's suppose if there are any delays, so such interest or penalties would definitely be captured in the P&L or should have been captured in the P&L. So that is one area which the auditor should also ensure whether such interest or this penalty, etc., have been considered in the books of accounts or not. If that has been considered, it's good. If that has not been considered, that is one area over which he can have a discussions with the management to be considered on a go-forward basis, because books of accounts are already closed and that is when the tax audit has started. Okay. Now, how will the auditor verify this information? For the verification of this information, auditor will obtain the data from HR, recompute the amounts of the information of the HR. For all of these payment due dates, this is on the basis of the knowledge of the auditor and the requirements of the statute at that particular point of time. For the purposes of verification of actual payment, auditor would need to verify the challans. So all of these payments would have been made. Yeah. So from the bank statements of the company, he may verify these amounts have been paid, and also he can refer to the challans. Challans in respect of the payments which are made and which will also reflect the date on which the payment has been made, and that should be the date we should get captured over here. Okay, clear on this? Clear on this part about the audit procedures? Now, before we move further, we will pick up some examples. So let us take an example in respect of whatever we have discussed so far, and all of you should try to answer this, please. say a company, I'm taking an example of a company only, CPS Limited, having a turnover of 350 crores. Okay, this company has a turnover of 350 crores. This company is into the automotive sector. They are into auto sector. Its statutory audit has been completed. Statutory audit for 2019-20 is completed. And this company is currently into the process of getting tax audit done. So tax audit is going on. And let's suppose the due date for tax audit is 15th of January 2021. Okay, and let's assume, I'm not sure about the date right now. This got extended. Let's suppose this is the due date. This is going on. Now, during the course of tax audit, few transactions are being looked at by the auditor. One is about the GST registrations. Which are multiple for this company. For some reason, this company has got multiple registrations. And there's one registration of corporate office. Now the company doesn't want to disclose all the GST registrations in Form 3CD. They want to disclose only the one. Okay, they don't want to disclose this one. They want to disclose only this one in Form 3CD. Okay. However, company has no reservation in showing the GST registration certificates or any procedure around the GST registrations which the tax auditor would like to perform. So company doesn't want to stop the tax auditor at all in terms of his audit procedures. It is absolutely okay on the part of the company. Yeah, number one. Number two is about the fixed assets. As around the fixed assets, there have been a lot of additions during the year because company got one plant set up at a particular location wherein there was a huge capitalization. Okay, there was capitalization of significant amount. During the year. This capitalization means the additions which took place during the year were all appearing as capital work in progress during the last year. Okay. So they were all appearing as capital work in progress during last year. All of them were appearing as capital work in progress during last year. Okay. So this CWIP was shown in the financial statements in the last year, which has now become additions during the current year. And this data is very voluminous. That's why the management thinks that because all of these additions have moved from CWIP to PPE or to fixed assets during the year, that's why there's no need to reflect all of those items in the Form 3CD under additions. Okay, and that too on a line by line basis. So management has a different view. Even if the additions are required to be shown, management is saying we will put the additions as one line item instead of hundreds of line items which are there. They are saying we'll show one line item over which auditor has a disconnect. Auditor is not comfortable with this point. Why? Because this is not only impacting the presentation or this sort of details which are required to be brought in Form 3CD, but the depreciation and the blocking or the block of the assets are also getting impacted as per the view of the tax auditor. Okay. So tax auditor is having a different view in respect of this method. Clear? Yeah. Then during the current year, though the company has always been compliant in respect of each and every due, there was a problem. Let's understand the problem. And this seems to be a genuine problem on the part of the company. The PF which got deducted and which got deposited was always on time except in two cases. Except in two cases, the PF was always deposited on time. Time means before the due date. Okay. Now the management wants that in the Form 3CD, there's a delay. And in fact, this delay was also not very significant. Only 1 day was delay. There was a delay of only 1 day. In both the cases, only 1 day. And that was also because of the fact that the person who was deputed on this role didn't know about it. Okay. So the person who was deputed on this role didn't know about it. So for the months of April and May, there were delays. This is because of the fact that the person was new to this role. He didn't know about the due date, and that's why he delayed this. But the moment he got to know about the due dates, this delay stopped happening. So after May, there was never a delay. Yeah. Now the management doesn't want to bring out this delay in Form 3CD. And the management wants that the date of deposit should be shown as 1 day earlier by the management itself in Form 3CD. And there's a genuine reason behind this. Let's understand the reason. It's not that management doesn't want to show the delay. Unfortunately, when this statutory audit got completed, during CARO reporting, okay, if you know about CARO, CARO also requires that whenever there are any delays, such delays should be reported. During CARO reporting, statutory auditor did not report these matters. statutory auditor did not report them. So these two delays, only two delays, these were not reported by the statutory auditor in his CARO report. And the statutory auditor and the tax auditor are different. So the management discussed this matter with statutory auditor. And the statutory auditor has also suggested the management that they should not report these delays. Otherwise, it will lead to a situation wherein for the same company, let's understand, the company is same. For the same company, at one place, in one audit report, the matter is not getting reported as a delay. And in other audit report, means the tax audit report, or in Form 3CD, these are getting reported as delays. Getting reported because in Form 3CD, if you're showing it as a delay, it's a delay only. So we are not thinking, so the tax auditor is not thinking of bringing any observation in his Form number 3CA or Form number 3CB. Yeah, it's all about also not showing all of these points in Form 3CB, because unnecessarily that would lead to a situation wherein somebody may question statutory auditor that why did he not report these delays in his CARO report. Okay, clear? So these have been the situations. There have been genuine problems, and in fact, this third one happens to be a very, very genuine problem, and there are good reasons for the tax auditor to understand about them. There's no intent as is clear, because after May there was never a delay, and secondly, statutory auditor is also advising the same. So it's not only the management, it's statutory auditor also who is advising the same thing. So that means it's the same thing. A chartered accountant is involved and who is also advising the same thing. Correct? Understood? Now, in respect of these matters, we need to understand how all of these things should be handled by the tax auditor. Yeah? Clear? So I don't have the space. So let me just try to bring out with some options which are possible in the given situation. So we can create situations, and once again, for easy reference, I'll put the numbers for these cases which are required to be handled. So there are three situations. So option number A, for situation number 1, I think the best way will be to change the report. Ideally, the report here should be Form 3CA. But if there is some information which is not getting captured and which has been subject to audit, then it's better to issue Form 3CB. Because that will cover this problem. Because anyways, management is happy if the auditor performs the procedures. So management is not stopping the tax auditor from performing the procedures. Because of this point number 1, the report should change from 3CA to 3CB. That is 1. For this point number 2, around the fixed assets, I think it's a big problem. This is not acceptable by the auditor. Why? It's a huge amount. So that's why for point number 2, auditor should give a qualification. Point number 3. Point number 3 seems to be a genuine problem, no doubt on the part of the management. And there are also problems for another auditor, which tax auditor should appreciate. And that's why this point of the management, this request of the management should be accepted by the tax auditor. So herein, no reporting and Form 3CD should not show any delay. Okay, so it's better to change the dates. Why to show any delay? Yeah. Option number B. Option number B is all about taking harsh steps. Point number 1. Keep the report same but qualify this. Means bring it as an observation. Point number 2. Keep the report same but once again put it as an observation. Observation means qualification only. Point number 3. Once again, don't accept the request of the management. Don't think what the other statutory auditor is saying. Okay, auditor is taking a very hard stand in this case, and that's why he is also not accepting this. He is saying, I'll simply put an observation. So that means he is very simply getting into the qualification mode. So you'll have no choice but to get into the qualification mode. Okay. Then option number C. All of you can just start thinking about the resolutions or the way these matters should be handled by the tax auditor. Option number C. For option number C, I think for first point, there should not be any problem. So nothing should be done. See, the management is giving the registration of corporate office, which is good enough because from the corporate, anything can be captured about the management. And anyways, auditor is auditing everything which he requires. Management is not stopping him. Yeah. And what's the point in putting all the GST registrations in the form? This is of no use, of no benefit to the department. Point number 2. See, on point number 2, once again, a softer stand can be taken by the auditor. When the management is saying that it's an addition which has moved from civil. Yeah, so one thing which needs to be appreciated in point number 2 is that no doubt there have been additions, but all of these additions have moved from civil. So these are not pertaining to the current year. Those have actually been relating to the previous, means the last years. So that's why if the management wants to bring it as a single line item, once again, there appears to be no problem at all. So once again, we can say nothing is required over here. For point number 3, this seems to be an integrity issue, no doubt about it. Because auditor can take a stand on everything. Auditor can take a position, auditor can remove the qualification, everything can be done. But to change the dates is something which is fraudulent in nature. Yeah. For this, it will not only lead to the qualification, but I think in this case, auditor would have to write to the income tax department because this seems to be an integrity issue, and report to income tax department. That's the best way to deal with this. Okay. Moving on to next point. Point number D. In point number D, for the first thing, I think once again the same sort of stand can be taken. Something similar to what was done in point number C, that nothing is required. For point number 2, this can be accepted by the auditor provided there's a proper note in respect of this in the annexure or in the details where these are furnished. So that means proper details. Okay, give detailed note for this. detailed note for this. Detailed note is for the purposes of income tax department, and for the purposes of auditor, there should be a specific representation. And specific representation should be given by the management. If that is taken, then I think there's no problem on this point. For point number 3, see, for point number 3, this seems to be a genuine matter. Once again, we can take the same position as we have taken in point number A. See, please understand that integrity cannot be challenged, which we did in point number C. Why? Because if the management would have got wrong intentions, they would not have ensured the deposit that the PF gets deposited on time after May. They may have wanted these delays to continue, isn't it? Secondly, if the management would have got wrong intentions, then the statutory auditor would not have supported the management. This seems to be a situation wherein the two persons are requesting the tax auditor because there has been some problem, but that was unintentional. And that problem was also minuscule, and it's also about CARO reporting, which has gone out to the ROC. So something which has gone out to ROC and which will not be in line with what is going to income tax department will lead to inconsistency, which will lead to confusions. Unnecessarily, the management will be troubled, and the notices may also get issued to the statutory auditor as well as the tax auditor. So unnecessarily, each and every party may get into trouble, and that too because of only 2 delays, on which interest penalty has also been paid. Everything has been paid. So why to get into this unnecessarily problem and to create a confusion? So that's why best way is to leave it. Form 3CD should not show any delays. Okay. Yeah. So we have got 4 options over here. Now you can just start thinking about all of these 4 options. And I remember somebody asked me yesterday, and definitely a question could be there in your mind, that what sort of questions can be asked in the exam. So if one has to look at the practicality and in terms of the MCQs, I think this sort of questions can be captured. Yeah, so this is the perspective which I am carrying, and that's why it's better to look into these situations and apply all of these situations practically, and then think through about the discussions that we had when we discussed all of those clauses. How would you deal with all of these situations as the tax auditor? Yeah, as a tax auditor, how would you deal with all of these situations? Let's think about it. Yeah. So you can just start moving on to the solutions. Great. So I've started receiving the solutions. Anjali is going with option number A. Very good. Then Ambika is choosing option number D, which is also chosen by Chavi. Okay, great. So it seems that 2 persons are looking at option number D. Any more responses? In case you want to share, you can just start sharing your responses here. I'll now move on to the solution. Looking at option number A, I think there seems to be big disconnect in terms of the understanding of the tax auditor, because he is thinking that if there is any problem in the tax audit, then he can just simply change the format of the audit report from 3CA to 3CB, which is not the case. 3CB is only required to be captured wherein statutory audit is not performed. In this case, statutory audit is performed. That's why the report has to be Form 3CA only. It cannot be other than this. Correct? It cannot be other than this. So that's why to think Form 3CB can be given will be the wrong option, and that's why we don't need to check point number 2 and 3. Yeah. So point 2 and 3 go off automatically. So we can just take out option number A. Then Anjali is saying, sir, it should be option number C. Very good. And Anjali is also giving a reason for this. Anjali is saying it should be option number C because no delay can be changed. Because the delay cannot be changed. So let's discuss about option number C only. Option number C requires that for point number 1, nothing should be done. And which is also there in option number D. If you look at the requirements of the clause in Form 3CD, it says that all the registrations are required to be captured. Does it give any option to give the registration number or not? No. And if the management, let's suppose, has got multiple registrations, let's suppose they've got 20 registrations. What is the problem in showing the registration number? Is there any problem in showing the registration number? It should not be there. Yeah. So that's why this point of the management is unacceptable when they say that the GST registration should not be given. So we can say that this is not acceptable. Option number C further says that for fixed assets, once again, if the management doesn't want to give the details of the assets, it's acceptable. Is this possible? Not at all. Why? Because on the basis of this detailed working or the details, depreciation will be computed. If these details are not given appropriately, depreciation is impacted because of this. Then it's something which will lead to an error. In fact, a significant error in terms of computations of taxable income. So that's why this point is also not acceptable. Point number 3, which Anjali specified, seems to be an integrity issue. And this point is also fair, that the date cannot be changed, and that's why it cannot be accepted. So definitely it's true, and that's why option number D should not be accepted. But in this case, let's suppose if the management has actually changed the date, or maybe they do not want to give this annexure at all. There could be 2 ways through which they can hide this: to remove this annexure or to change the date. In both the cases, what is the responsibility of the tax auditor? Tax auditor has got his report. In the report, he will put his observations, and that observation is also going to the income tax department, because this form 3CA, 3CP is meant for whom? Income tax department only. Correct? So that's why there is no need to report it separately, because he is already reporting it in the form of his audit report. Correct? Yeah. But because point 1 and 2 are not correct, that's why option number C is also not acceptable, and neither is option number D. So what is the option that we are left with? Option number B. And let's evaluate option number B also. So what does it say? If we go by option number B, it says report this, and definitely report this, which is something we have understood, that all of these matters are the matters wherein reporting will have to be done by the tax auditor. Tax auditor cannot skip any of these points. One may think that, sir, it's only about giving the GST registration numbers. How can there be a qualification on this? It's not only a qualification, it's something which is appearing as an observation of the auditor. And that is something which is very, very important. And that's why tax audit is in place. If the tax auditor will not capture this information, then what's the use of the tax audit? So that's why it has to be option number B. Okay, clear on this? So now we will move further. Moving on to next clause, clause number 21. It says, please furnish the details of amounts debited to statement of P&L, being the nature of capital, personal, advertisement expenditure. So once again, what is the base to start in respect of this report? The base will be P&L, because any of the amount which is in the nature of capital expenditure, which is in the nature of personal expenditure, which is in the nature of advertisement expenditure, and which has been debited to P&L is required to be reported over here. Okay. If that is not debited to P&L, then it will not get reported over here. And now we can move on to an attachment to look at some of the items which will get captured over here. Capital expenditure, personal expenditure, advertisement expenditure in any souvenir, brochure, tract, pamphlet, or alike published by a political party. Expenditure incurred at clubs, being entrance fees and subscriptions. Expenditure incurred at clubs, being cost for club services and facilities used. Expenditure by way of penalty or fine for violations of any law for the time being in force. Expenditure by way of any other penalty or fine not covered above. Expenditure incurred for any purpose which is an offense or which is prohibited by law. Okay. Now in this respect, the auditor will do the scrutiny of expenses. Scrutiny of expenses means auditor will scrutinize the ledgers. Some of the ledgers which he can scrutinize could be related to the taxes. Generally, you see some account codes, rates and taxes. Sometimes companies also maintain separate ledgers for taxes, etc., which are in the nature of penalties, interest, which are paid by the companies or the entities during the year. But to capture the information about the expenses which are personal in nature will be difficult, will be difficult on the part of the auditor. Okay, so that's why what would the auditor do? Auditor would generally give these notes, which you can see, note number 1, 2, which are more of clarificatory, wherein the auditor will say that during the course of his audit, he has performed procedures, looked at the accounting requirements, but he has also, on the basis of his discussions, inquiries with the management, concluded some of these items. Okay. Now, an expenditure in respect of something which is personal in nature may be very, very difficult to be tracked. So what can the auditor do? Auditor can look at the expenses, and during the course of his review, let's suppose if he comes across the expenses of the directors, let's suppose who also happen to be the shareholders of the company. Many a times in case of closely held companies, you see a lot of expenditures are in, a lot of expenses are incurred by the company or the entity in respect of the directors, and the directors are also the shareholders. And it may appear as if those expenses are the personal expenses of the directors and not really the expenses for the business of the company, and which is then again required to be reviewed by the tax auditor. And during the course of his review, he will also need to have an understanding about the reason for incurring that expenditure. But he just can't go beyond that. He just can't challenge this. Just to say that this expenditure should not be incurred at all will not be possible on the part of the auditor if the management has got appropriate explanations around those expenditure and also substantiate or justify as to why such expenditures are important for the business of the entity. Okay, clear on this? Yeah. Moving further on to this, it requires amounts which are debited to P&L, amounts which are inadmissible under section 40A as payment to non-resident, referred to in subclause I, details of payment on which tax is not deducted. Means if the payments are made to non-resident and the tax is not deducted on such payments, then the date of payment, amount of payment, nature of payment, name and address of the payee. Next, details of payment on which tax has been deducted but has not been paid during the previous year or the subsequent year before the expiry of the prescribed time limit as per Income Tax Act. There again, date of payment, amount of payment, nature of payment, name and address of the employee, of the payee. Herein, another line item which gets added is the amount of tax deducted. If you'll see in A, it was not there. If you'll see over here, it's not there. Here, there are only 4 points. Can you see this? There are only 4 points. However, under this, there are 5 points. Why? Because over here, if the payment is not, if the payment has gone without deduction of TDS, it's about TDS, tax deducted source, then it will not get captured because there's no deduction of tax. But in point number B, tax has been deducted but has not been paid. Okay, so all of these particulars are required to be furnished, and all of these particulars will once again be furnished in the form of a separate annexure, because many of these details will require a lot of data to be captured. Just a minute. Okay, so talking about this, now how will the auditor verify this? The first thing will be to look at the payments of the NRIs, non-residents. When the payments are made to non-residents, auditor can look at their ledgers. And this is something which he can easily track from the books of accounts of the company. From the ledgers, he can track, he can verify whether the amounts have been made to non-residents on which tax should have been deducted. And if the tax should have been deducted, whether that was deducted or not. This is once again possible by reviewing the ledgers and by checking the records of those known residents. In case those have been deducted but not deposited, that will be known to the auditor if the management will not have any challan for these payments. If the management will not have any challan for these payments, then from there auditor will get to know about it. Clear? Clear on this? Moving further on to point number B on this. Just one minute. Sorry, point number C on this. Amounts debited to the statement of P&L being interest, salary, bonus, commission, or remuneration inadmissible under section 40B, 40BA and the competition bureau. So if there are any such components, those are required to be captured. And once again, for this, what will be the basis for the tax auditor to verify? The basis will be the P&L. Because in the P&L, auditor can go to all of these ledgers, interest ledgers, salary ledgers, or the salary details, or the bonus ledgers, or the bonus details. All of these documents, all of these records, which will be there with the company. That means the basis will again be the books of accounts, but the starting point for the auditor will be the P&L, because these are required to be captured once again only if these are debited to the statement of P&L. Okay. Moving on to next point number D. Disallowance or deemed income under section 40A(3) on the basis of the examination of books of accounts and other relevant documents or the evidence, whether the expenditure covered under this section read with rule were made by account pay check drawn on a bank or account pay bank draft. If not, please furnish the details. Further to this, it says, on the basis of examination of the books of accounts and other relevant documents or evidence, whether the payment referred to in section 40A(3A) read with this rule were made by account pay check on a bank or account pay bank draft. If not, please furnish the details of amount debited to the profit and gain of business or profession under 40A(3A). Now, in this case, what is required to be reviewed by the auditor? Auditor is required to review if there have been any expenditures for which the payments have been made in cash. And for cash, there are certain limits which are attached to them. If the cash payments for certain expenses are made above a particular threshold, then those expenses get disallowed. So that's why in this case, if the payments have not been made by a check or say by bank draft, then those details are required to be furnished over here. Okay. Now in this case, let's suppose if the payments have been made through account pay check or account pay bank draft, there again, to verify whether that was done through account pay check or account pay bank draft will not be possible for the auditor. Why? Because if these payments would have been made, then these checks would have gone out. Yeah, these checks would have gone out now. And it will not be possible for the auditor to track it. Correct? So that's why Herein, the auditor will have to specify, auditor will have to give a note that this is on the basis of the representations, on the basis of the management discussions, that there is no item to be reported. If at all, nothing appears to be reportable under this case. Moving on to the next clause, it requires if there is any provision for payment of gratuity which is not allowable under section 40A(7). So if any gratuity provision has been created, so gratuity has not been paid, only the provision for gratuity has been created. Gratuity is what? Gratuity is an employee benefit. Then that amount will get disallowed and will get allowed under income tax only when this is paid in cash. Cash means only when it is paid. Now such amounts are required to be reported over here. And how can the auditor verify this? The auditor can verify this by looking at the books of accounts. In the P&L under the employee expenditure, he would see this item appearing. And if this happens to be a provision, then this would also be appearing under the provisions in the financial statements, in the books of accounts. From there, he can capture it. Okay. Next, it says any sum paid by the assessee as an employer not allowable under section 48(9). Particulars of any liability of a contingent nature. Amount of deduction inadmissible in terms of section 14A in respect of expenditure incurred in relation to the income which does not form part of the total income. Amount inadmissible under the proviso to section 36(I)(3). All of these items, as we have discussed, once again are required to be captured from the books of accounts. In respect of contingent nature, etc., how can we verify that? Very simply, go to the financial statements and that will become the basis. And that is how auditor will have to pull out all of this information. See, it's all about filling the form. So far, you would have understood that when we are discussing the requirements of various clauses, it's all about putting the information. And all of these information will come from the books of accounts only. Because in most of the cases, you would have read that whether this amount was debited to P&L, whether this was not debited to P&L, every information is getting captured from the books of accounts. So that's why it's collation. This information collation is very important, because if the data is not captured properly, then of course it may lead to problem in form number 3C. Okay. Moving on to clause number 22. It says amount of interest inadmissible under section 23 of Micro, Small and Medium Enterprises Development Act 2006. Now this is something which also requires a disclosure in the financial statements these days. As per Schedule 3, the financial statements which get prepared, they need to carry a disclosure separately for MSME in terms of the amounts which are due to them. And in most of the cases, you'll see interests are also due to them which are not paid. So they remain outstanding. Whether that is paid or not is not a matter of concern. Auditor needs to verify this. How will the auditor verify this? Auditor will have to first of all check whether such disclosure is given in the financial statements or not. And if the disclosure is given in the financial statements, he should trace this amount to the financial statements. Number 2, in respect of MSMED, auditor should also perform test check. Auditor should also look at the process which the management would have set up to capture all of their parties as MSMEDs. Means what becomes their basis to assess whether a particular party is MSMED or not. Okay. Once he is through, once he has understood that process, he will also verify on a sample basis, on the basis of the document. So how can the auditor verify? How can the management ensure that a particular vendor of the management is MSMED or not? those vendors would have obtained their registrations for MSMED. Those registration documents vendors would have provided to the company. If though they would not have obtained the registrations, they would have provided their declarations to the company that they are not registered as MSMED. Okay, yeah. So all of these documents will have to be verified by the tax auditor, but that's again on a sample basis. The most important point herein once again will be to trace this information to the financial statements, because there should not be any disconnect in respect of these points. Okay. Now, before we move further onto this clause number 23, I'll come to some of your queries. I think I missed some of your queries. Mahesh is asking, sir, is it mandatory to know and present the clause number while answering 3CD related questions? I think I'll have to come back to your query towards the end of the session, please. Harshad is saying that the provision is not made for gratuity, but it is required to be made. Then it is to be reported. No, something which is debited to the P&L has to come here. Harshad is then asking, sir, if the books of accounts furnished by the management contains errors, then the management will be held responsible for this or the auditor. So the management will be held responsible definitely, because the preparation of the books of accounts is the responsibility of the management. But if there are any material errors which the auditor may have captured through his diligence, through his procedures, and for which the auditor will not have good reasons to explain as to why he could not capture the material errors, then the auditor will also be held responsible for those material errors. So that's the responsibility of the auditor, to ensure that the books of accounts, or for that matter to say that the financial statements are not materially misstated. Okay. So if you have any more queries, you can just send it across. Yeah. So before we move on to this clause number 23, we can take a break. Yeah. So we can take a break for 10 minutes, and after the break, we will continue with our discussion on this form 3CD. Hi. So moving on to the next clause now. Clause number 23. Particulars of payments made to persons specified under section 48(2)(b). So let's understand this requirement by looking at this annexure. This clause requires that if there are any transactions with the related parties. Now these are the related parties, not from the provisions or as per Ind AS or Indian GAAP, but these are, I'm just using this term related parties as per Income Tax Act. These are called as specified persons. These are called as specified persons. So if there are any transactions with those specified persons, those are required to be reported over here. Now, who are the specified persons? The criteria for the assessment of specified persons is given as per Income Tax Act. This clause requires that any of those transactions should be captured over here when the payments have been made to them. And in this case, many a times, even if the payment is not made, even if the transactions are carried out, that is also shown. And a note is given that this was a transaction which took place during the year and which was not really a payment, but that was more of an accrual. And this is to ensure that all the current year's transactions with all of these specified persons get reported under this clause. And let's understand some of the related parties over here which will get captured. Ultimate holding company, directors of the company, and the fellow subsidiaries, they all fall under the purview of this part of the this provision of Income Tax Act. The particulars require the nature of the transaction to be specified. So let's suppose if there are import of goods, then it is specified. For the directors, the remuneration has been paid, that is required to be specified, and the amounts for that is also required to be given over here. The basis for checking for this type of detail, and as we have discussed, that this is all about filling the form. Yeah, it's all about capturing the information in this form and to ensure that the information is captured accurately in the form and completely in the form. In most of the cases, it's about capturing the data from the books of accounts or the financial statements. Similarly, over here, the auditor will look at the related party schedule in the financial statements. The note which captures the information about the related party transactions, related parties' names, and related parties' balances in the financial statement. So that will form the basis. Because most of those parties will also meet the criteria of specified person under this section of the Income Tax Act. So auditor will first of all have to ensure whether all those parties which have been reported in the financial statements have got captured over here or not. If those have been captured over here, then first step of the auditor to ensure the completeness of the transaction is completed. Secondly, there could also be certain parties which may be specified persons, but which may not be the related parties, okay, but may not have been shown as related parties as per Ind AS or as per accounting standards. So how do we deal with those parties? For this, the auditor will have to identify any other specified person which does not happen to be a related party as per accounting standard. And once again, this procedure will be to ensure completeness, and we can say this will be the second step to ensure completeness of all of the transactions in terms of reporting under this clause. And this can be done by having discussions with the management, by understanding their transactions, and by also looking at the group structure, also looking at the organization structure through which auditor will get to understand about all of these specified persons which are possible. Okay. And in respect of those specified persons, the ledgers will be reviewed, ledgers will be scrutinized, the transactions with those parties will also be scrutinized on a test check basis. These will not be done on a 100% basis, but of course the transactions with all of those specified persons will have to be captured in totality. So there will not be any piecemeal sort of distribution over there. Yeah, clear on this? Moving on to the next clause. Clause number 24. Clause number 25, clause number 26. If there are any amounts which are deemed to be profits and gains under section 32AC, 32AD, 33AB, or for this matter, such sections under Income Tax Act, those are required to be captured over here. And for this, once again, the auditor will have to understand the nature of transactions, which will be done by review of the books of accounts. On the basis of the review of the books of accounts, auditor will be able to capture all of these points and understand whether any of such amounts exist and where should such amounts be reported. Any amount of profit chargeable to tax under section 41 and computation thereof. This is again possible by reviewing the P&L, because in the P&L any sort of such income will be reviewed by the auditor. When the auditor will review all of these incomes which are captured in the P&L of the entity, auditor can then verify, auditor can get into the details of the income, the nature of that transaction, and then can assess whether that will fall under section 41 of the Income Tax Act or not. If that falls under section 41, then it will get captured over here and its computation will come. If that doesn't fall under section 41, then it's there in the P&L, it's there in the income, but it will not be reported over here. Now we move on to another very important clause, clause number 26. You can just quickly read the requirements of this clause. Just 1 minute. Quickly read the requirements of this clause. In respect of any sum referred to in clause A, B, C, D, or for this matter up to G of section 43B, the liability for which, point number A, pre-existed on the first day of the previous year, but was not allowed in the assessment of any preceding previous year, and was paid during the previous year and was not paid during the previous year. Point number B, the liability which was incurred in the previous year and was paid on or before the due date for furnishing return of income of the previous year, or was not paid on or before the due date. Now, this clause is very important from the point of view of computation of tax, and that's why this particular clause is very carefully reviewed by the management. Many a times, tax audit keeps getting delayed only because of this clause, and I'll tell you the reason why. And in most of the cases, it's been seen that there's a confusion around these two, means point number A and B means these two requirements of this clause. For this to understand and to get a better understanding of this, first of all, I'll take you to both the annexures, and then we'll try to understand what all reporting is required over here and what will be the point of confusion. Okay. So we are moving on to attachment number 8. So this is for point number A. And you may read this requirement again, please. Details of sums referred to in section 43B, the liability for which pre-existed on first day of the previous year and was not paid during the previous year or during the preceding previous year, or was paid during the previous year. So let's understand which all items will fall under section 43B. Section 43B requires those expenses to be captured which have been taken to P&L, means which have been recorded as expense in the books of accounts, but which are not allowed by the income tax department till the time those expenses are actually paid. Means they will be allowed for the purposes of computation of tax only when they are paid. So if they are not paid, they will not be allowed. And whenever they get paid, they will be allowed. So that means there's a difference between the requirements of Income Tax Act and the way books of accounts are recorded. And for that, one example could be leave encashment. So I'm just writing it up. Leave encashment is one example for that. Leave encashment. Okay. Now, leave encashment gets recorded in the books of accounts on an accrual basis. And generally we see actuarial valuation. And generally we see an actuarial valuation for this leave encashment. But leave encashment will not be allowed by the income tax department till the time leaves are actually paid to the employees. So I've just picked up this as an example. Now this is a matter to be reported under section 43B, which gets captured over here. Now if this leave encashment was appearing as payable on the first day of the previous year, then it will be recorded in this clause, means under A. Okay. And after this, if this is paid, its amount will come, date of payment will come. As you can see, date of payment will come, amount which is reversed, if any, and amount of liability which still remains outstanding, that will come, means the outstanding balance. Okay, that is how it will be captured. Moving on to another clause, that is point B of 43B. Now on 43B, you will see similar sort of items. PF, performance bonus, gratuity, leave encashment, all of these items will come. So leave encashment is there as well. But let's understand the requirement of this point number B once again. It says liabilities which are incurred during the previous year. Only those liabilities will come which are incurred during the previous year. Other liabilities will not come. Okay. And once again for B, I will take an example of leave encashment. Then let's see what are the requirements over here. It says amount which is incurred during the previous year, amount which is paid with the date. So date and amount are required to be captured. Amount which is unpaid means the closing balance, and whether this was taken to P&L or not, means whether this amount moved to P&L or not. This is amount which is required to be recorded over here. Okay. Now I'll come to that point of confusion at the end. Let's try to understand how will the auditor audit this information. What will be the audit procedures on the part of the auditor in respect of this? First, in respect of this balance which appeared at the beginning of the previous year, what will the auditor do? Auditor will trace all of these balances. So this was one line item. Similarly, there can be multiple line items. All of these balances will be traced to the closing balance, which would have been reported in respect of these items in the form 3CD of last year, means preceding previous year. Correct? Then in respect of expenditure which is incurred during the year, how will the auditor verify this? In respect of expenditure which is incurred during the previous year, this can be verified by the auditor by looking at the P&L. Because in the P&L, entire amount of expenditure will be coming, and the auditor will have to pick up only those line items, those expenses from the P&L which get captured under section 43B. And this requires knowledge of section 43B for the auditor to assess and evaluate which all items will come over here, because each and every item will not come. It's only the selective items which will come. Correct? Yeah? Okay. So through this, the first column of both these parts, A and B of 43B, will be verified. What's the next step? To check the payment. Now, how can the payments around all of these items can be checked? Very simply, payments can be checked through the bank statements. In respect of PF, for example, there will be a challan. Yeah. So all of these payments can be easily verified by the auditor through the bank statements, because the bank statements will give the details in terms of the amount which is paid and the date on which such amount has been paid. So the auditor will verify all of them from the bank statements. Yeah. In respect of these type of payments which have been made, it's up to the auditor whether he wants to check all of these payments in terms of their dates, or he still wants to keep a test check only. It's up to his wish. This is because of the fact that there could be various items which may get reported over here. So currently on the screen, if you'll see, you may think, so there are only 5-6 line items. What will a test check do in this case? So if this is such a small data, then the auditor will definitely check all of these payments. But let's suppose if these are running into many line items. If these are running into many line items, then the auditor will have to verify not all items. He will have to verify some of those items. But if the auditor feels there is a need to check more, that is definitely possible, because it's all dependent on the judgment of the auditor. As per his judgment, whether he wants to check all or only some of them. Okay. And then the closing balances will be derived, and that is nothing but the arithmetical computation. So far, up to this stage, everything is okay. And this appears to be a very easy procedure to be performed. There's no doubt this is an easy procedure. The only problem in respect of this clause is about capturing of information. Means identification of all of these heads which are there in the books of accounts and which will fall under section 43B. And that's why for doing this, auditor will have to scrutinize the books of accounts. Because through the books of accounts, he will have to identify the heads, identify the transactions which will get covered under section 43B. Okay, clear on this? Yeah, clear on this point? Now moving on to the next part of this requirement. I think I have a query from Prashant on this. Prashant is asking, amount of liability on the first day not paid during the previous year, but paid before the due date of furnishing of return, where to report? I'll come to this point. Okay. Then I think Ambika Mahesh, I'll come to your queries later. Now I'll come to the another very important part of this clause in terms of its reporting and in terms of its checking. And this has got something to do with Prashant has also asked me that, sir, if this is paid up to the date of furnishing of return, where do we report it? Yeah. So let's understand this. If you look at clause number A, it talks about all the liabilities which existed on first day of the previous year. So let's suppose first day of the previous year is, so it's 2019-20. So that means it talks about all the liabilities which remained outstanding on 1st April 2019, or for us to understand, these would have remained outstanding on 31st March 19. Okay. And these were not allowed in the assessment of preceding previous year, which is possible because of the fact that if we go back to previous year, if we go back to preceding previous year, under what situation they would not have been allowed? If you look at 2018-19, so this is 31st March 19. Okay. So definitely these liabilities are outstanding over here. But these liabilities were not only outstanding on 31st March 19. They were also not allowed in the assessment of preceding previous year. Means they were not paid up to the due date of furnishing ITR of 2018-19. So let's suppose that date was 31st of October. Okay. So if there was a liability which remained outstanding on this date, but which got paid, say on 31st of May 2019. Do we need to capture it over here? No. Do we need to capture it over here? No. So any liability which remained outstanding over here and which also did not get paid up to this date will be captured over here. Clear? Yeah. This is because of the fact that if this would have got paid during this period, then that would have been reported in the last year's Form 360. Now it is not required to be reported. Okay. So let's suppose this amount is 100. For leave encashment, let's suppose this amount is 100. Yeah. Next step. And this is old liability towards leave encashment. Now we are moving on to current year. So in the current year, some leave encashment would have been accrued. Yeah. Let's suppose in the current year, 150 is the amount of expense accrued towards leave encashment. Now, because this is incurred during the previous year, that's why, can it go over here? No. Why? Because if it is getting incurred over here, it cannot go to this. Correct? Okay. Now we are on 2019-20. So this is 1st April 2019. This is 31st March 2020. And let's suppose its due date to furnish the ITR is 31st of October 2020. So this date got extended, but I'm just ignoring that. This is only for the purposes of our example. Okay. Now, in respect of this this 100 rupees is outstanding on this date. So we can say this is outstanding on this date. Let's suppose out of 100, 80 is paid. 80 is paid up to during the financial year only. Yeah. So what are we left with? 20. So 20 is the balance on this date. Okay. Now let's suppose out of this 150, 75 is paid. Say on this date. Let's suppose 75 is paid on this date. So on 31st March, what is the balance which is outstanding? 70. Okay. Now assuming that nothing is paid out of this, or we can say out of this, and nothing is paid out of this up to the due date. Let's suppose if nothing is paid up to the due date. In such a case, in the next year's Form 3CD, over here, in clause number A, what amount will be reported? Can you tell me, all of you? What amount will be reported on 1st April 2020 under clause A? Quickly. Can you tell me under clause A on 1st April 2020, what amount will be reported? Quickly. So next year, under clause A, both the amounts 20 and 75 will get reported. Why? Because again, if you go back to the requirements of clause A, what does it say? Any amount pertaining to 43B which remained outstanding on the first day of the previous year and which was not paid up to the due date of furnishing of return of preceding financial year will get captured over here. That means next year when you will start, some of these two, 20 will go here and this 75 will also go here. So we will not say that because this was the closing balance of clause number B. So that's why next year when we start clause number B, this closing balance will also go to clause number B. No. This closing balance of clause number B, if this remains unpaid even during this period, will go to this clause. And of course, this balance of clause A, if this remains unpaid up to the due date, will also go to this clause. Clear? So that's why whenever we change this or whenever we move this to next year, what's the first check for the auditor to perform? The opening balances. And in terms of the opening balances, when he will be comparing this amount of 100, what does he need to check? The closing balance of A as well as B. Some of these two should come here. Now clear on this? Now this is one area which is generally not understood or there is a lot of confusion, and that's why many a times mistakes are made in form 3CD under clause number A as well as clause number B only because of this point. Clear? All of you? Yeah? Anjali mentioned that, sir, this should be 95. Very good. Harshad said 20. So Harshad, I'm hoping that you would have understood this now. Yeah? Okay, so coming back to the queries of Mahesh and Ambika. Let me just go to that particular clause. Mahesh is asking, sir, what is ultimate holding company and holding company? Difference here in that example. See, ultimate holding and holding means, let's suppose A has B as its subsidiary and B has C as its subsidiary. So for C, who is the holding? B. And ultimate holding for C is A. Okay. Clear on this? Then the next query of Ambika, just give me 1 minute. Ambika is asking, sir, for this clause number 23, clause number 23 is about the specified persons. Auditor needs to apply the requirements of SA 550. See, everywhere you need to understand that all the auditing standards in terms of their relevance are required to be applied by the tax auditor also. Means whichever part of the auditing standard tax auditor will believe is relevant in the context of his tax audit, he will have to use that. Yeah. So accordingly, you can just draw the inferences from this particular standard also, which you asked me. Clear? Yeah. So now moving further. This clause 26 is done. Now we move on to clause number 27. Alright, so clause number 27 says amount of SENVET credit availed of or utilized during the previous year and its treatment in the statement of P&L and treatment of outstanding SENVET credit in the accounts. Particulars of income or expenditure of prior year, prior period, credited or debited to the statement of P&L. So 2 points have been covered over here. So I'll talk about this point number B first of all. Prior period, we all know any item which pertains to the previous year, which is coming to the knowledge of the auditor in the current year. Now, under Indian GAAP and under Ind AS, there is separate treatment for that. But both the Ind AS, both the GAPs require disclosure in respect of such items. So that's why whenever such item would be there, it would be appearing in the financial statements if those are significant. So the first step for the auditor to verify prior period items will be to look at the financial statements and the disclosures and to capture that. And if those are not very significant, those are not significant enough for the financial statements, then the auditor will have to have discussions with the management, and during the course of his audit procedures, auditor will have to find out if there are any prior period items, because if those are not very significant enough, then the auditor may not be able to capture all of them, because it will be about 100% testing required on the part of the auditor to check each and every error which belongs to the previous year and which may not have been covered separately in the financial statements also. Plus, the auditor can also look at the materiality in this case. Auditor will also look at the significance of the matter. If that is not considered significant enough for the financial statements, at times it may also not be considered to be significant enough for the purpose of reporting under this particular form. Now, for this 27A, we will go to an attachment, that means annexure, to understand its requirements. So it says amount of SENVET credit availed and utilized. Now we don't have any SENVET as such now, except in the form of GST. So this GST is now required to be captured over here. So what will be given? Opening balance of GST input and the credit which was availed during the year, credit which was utilized during the year, and of course the closing balance. Now, what will be the basis of verification of this? For the purposes of verification of this input, etc., 2 records will be reviewed by the auditor. One is the books of accounts, because in the books of accounts, input, credit, etc., would be recorded by the management. And from the books of accounts, auditor can capture all of this information. So first is the books of accounts. Second, other than the books of accounts, auditor can capture this information. Auditor can capture this information from the GST portal in respect of entities which are registered under GST. Most likely for those entities only tax audit will become applicable, because GST also has got certain thresholds beyond which its registration is mandatory, otherwise it's not mandatory, and those thresholds are such that if an entity will cross that threshold, then most likely it will fall under the purview of tax audit, otherwise it will not fall under the purview of tax audit. So that's why any of the entities which are getting their tax audit done, we can just assume that they will also be subject to registration of GST. And that's why they will have the portals of GST, and all of these records around the input, credit, etc., in terms of the opening balance, in terms of the credit availed, in terms of its utilization, in terms of the closing balance, can be tracked through the GST portal. In fact, when we'll understand the requirements of GST audit, this also happens to be one of the reconciliations. which are required on the part of the management to do, and then the auditor to check whether these inputs or these balances which we discussed, that there are two sources to look at this information. One is the books of accounts and second is the GST portal, whether there are any differences between these two or not. Okay. Now for us, the important thing will be to look at the books of accounts. So the base for reporting in this case will be the books of accounts. But in case the auditor believes that the books of accounts and the GST portal have got some differences, then the auditor can also report that difference over here. If you see, there's a note given towards the end of this reporting. It says actual GST input tax credit. ITC's input tax credit as per the GST portal is rupees so and so, and as per the books is rupees so and so. So there's a difference between these two amounting to this much amount. Okay. So this is how auditor would report the requirements of this clause. At the same time, auditor will also establish a correlation of the reported amounts under this clause with the GST portal. Yeah, because these are all statutory records, so that's why it's always better to report any of these differences if they appear to be in the GST portal. Okay, clear? Now moving on to the next clauses. Whether during the previous year assessee has received any property being share of a company, not being a company in which public are substantially interested, without consideration. So that means assessee has received any property, and that property is what? Share of a company, excluding the company in which public is substantially interested. And that property means that share has been received by the assessee without consideration, or for which assessee has paid the consideration, but that is not adequate. Adequate means that is not as per the requirements of section 56(2)(7)(a). If there is any such instance, that is required to be reported over here. Now, how will the auditor verify this? For the verification of this, very simply, auditor can look at the additions which would have taken place in the investments, because any of these properties which the auditor would have acquired would be there in the additions, would be there in the books of accounts of the company. So from that, auditor can verify whether any such addition has taken place during the year or not. And also he will be verifying whether the nature of such item qualified to be reported under this clause or not. If that qualifies to be reported under this clause, then of course it will get reported. I think in this case, the biggest challenge for the auditor will be to verify what is inadequate consideration, because if the property is acquired without consideration, then it's easy for him to comment that it's without consideration, because at least some consideration should be paid for anything. So therefore, if something is acquired without consideration, means no consideration has been paid at all, that is good. But inadequate consideration is quite subjective in nature, and for which he will have to get into the requirements of this particular section of the Income Tax Act. Yeah, on the basis of the requirements of this particular section, management would have also evaluated whether that consideration is adequate or not. So auditor will have to have discussions with the management, inquiries with the management to understand whether the consideration was adequate or not, what was the market valuation around it, what was the valuation as per this section, and if he believes that this is inadequate consideration, then this should be reported over here. Moving on to clause number 29, 29A, 29B, all of these whether during the previous year the assessee received any consideration for issue of shares. So the assessee has issued shares and received amount for this. And this amount which the the assessee has received exceeds the fair market value of shares. Once again, it's similar type of thing. In 28, assessee was receiving the shares. Now he is issuing the shares and receiving the cash. Correct? So once again, this can be done by looking at the books of accounts, because if you would have issued any shares, that will be appearing in the books of accounts, which he can easily track and verify. But the important matter once again here will be very subjective, and that is about evaluation of fair market value. This must have been done by the company, the assessee. If the assessee has not done this, then the auditor would require the assessee to provide evidence, substantiate as to how this particular issue has really met the requirements of this section. And this is generally done by the companies also. And that will become the basis for the auditors reporting under this clause. 29A says whether any amount is to be included as income chargeable under the head income from other sources as referred to in clause number 9 of section 56(2). If yes, furnish the details, means nature of such income and amount thereof. And for 29B, it says if that falls, if there is any income which falls under section number 56(2) and this clause number 10. Okay. So if there is any such income which is falling under any of these clauses, then the assessee is required to report the nature of such income and the amount. Now, in respect of nature of such income and amount, this reporting is again possible. The important thing once again for the tax auditor to evaluate will be whether it's really the income which will qualify for its reporting as per 29A, 29B or not. Sorry, I didn't move the slides. Yeah. So that's something which is important on the part of the tax auditor to analyze and evaluate. On the basis of his assessment, tax auditor will be able to conclude this. And that's why once again, you will understand that in respect of all of these reportings, a good knowledge of Income Tax Act will be required on the part of the tax auditor. And in case he has got any challenges around it, he should definitely have consultations on those matters. Okay, he should have consultations on those matters. Correct? Yeah. Moving on to clause number 30. It says details of any amount borrowed on hundi or any amount due thereon, including interest on the amount borrowed which is repaid, otherwise than through account paid check. So the important aspect here is not about the amount which is borrowed, but about the amount which is borrowed and which is not through an account paid check. Yeah, just 1 minute. Now for this, once again, it's not easy for the auditor to track, because if the amount has been borrowed through account paid check or not, all of these checks will not be in the possession of the company or the entity. If the amount would have been borrowed, the checks would have been deposited with the bank, and all of those checks are not available for the auditor to verify. So he will not be able to track it. He will not be able to trace any of them. So that's why in this case, generally a note is given that is about the representations which are taken from the management as around any of such borrowings which would have been obtained through check, but those checks are account pay or not is something which the auditor will not be able to comment on. Okay. Moving on to clause number 30A and 30B. This is something which is in respect of the requirements of transfer pricing. So let's understand whether primary adjustments to transfer price as referred to in 92 CE has been made during the previous year. If yes, furnish the details of that primary adjustment, amount of primary adjustment, whether excess money was available with associated enterprise, which is required to be repatriated to India as per the provisions of that section. If yes, whether excess money has been repatriated within the prescribed time. If no, amount of imputed interest income on such excess money which has not been repatriated within the prescribed time. Expected date of repatriation of money. Moving further on to this, whether the assessee has incurred any expenditure during the previous year by way of interest or similar nature exceeding 1 crore rupees as referred to in section number 94B. And once again, if you have to look at the requirements of this, amount of expenditure by way of interest or of similar nature incurred, earnings before interest, tax, depreciation, amortization during the previous year, amount of expenditure by way of interest or of similar nature as per the requirements of this income tax section, details of interest expenditure brought forward, details of interest expenditure carried forward. Okay, so let's talk about both of them. Now, talking about both of them, so first is in respect of the transfer pricing requirements. So for tracking this, what can the auditor do? Auditor can look at the transfer pricing documents or the transactions with the associated enterprises which would have taken place. So companies which are subject to these clauses, that means companies which are subject to transfer pricing, they would have done their transfer pricing studies. So that study will become the basis for the auditor to comment on this aspect. And this once again is not something which is a very simple thing on the part of the tax auditor. Transfer pricing again is a very specialized area. So therefore the auditor may also require the need to involve a transfer pricing specialist. Many a times auditor may be knowing about it, but many a times auditor may also not be knowing about it. So generally you see that the transfer pricing specialist is engaged by the auditor in respect of these matters related to the company in case these are applicable to the company, and that becomes the basis. And on the basis of those transfer pricing documents, auditor will have to evaluate whether any of these amounts or such reporting requirements exist. Okay, and that will also be the evidence which the auditor would get for the purposes of his testing. Similarly, if the auditor has expenditure, so if the assessee has got any expenditure during the previous year which is in the nature of interest or something which is of similar nature which exceeds 1 crore rupees, okay, which exceeds 1 crore rupees as per this section number 94B, then all of these reportings are required to be given. So once again, auditor will have to go as per the requirements of section number 94B, and when he will be going through the requirements of section number 94B, he will have to look at the expenditure of interest or similar nature which is crossing this 1 crore. And I think this can be very easily tracked by the auditor. Auditor can look at the P&L. In the P&L, the interest or this particular expenditure would be appearing. Auditor have to just filter out the expenditure in terms of the amount which is crossing 1 crore. So if that is crossing 1 crore, that is something which will fall under the purview of this particular clause, and accordingly auditor will have to verify all of these requirements and get them reported in form number 3CD. Okay, clear? Now if we move on to the next requirement, I would say this next requirement is all about certain advances which are taken or given by the assessee. It's also about certain loans or deposits which are given or taken by the assessee. I can see a couple of queries from you in the meantime. Harshad is asking, sir, the liability under section 43B that pre-existed because of paid or not paid during the previous year, and the liability that was incurred or not before the due date of return, both have to be reported. No, the liability which was not paid before the due date has to be reported. Harshad is then asking company, so it's generally a listed one. Okay, now moving on to this clause quickly. As I specified that this clause is all about particulars of loan or deposit or advances, and it basically extends to both given and taken. And there are various clauses which are in line with this. So I'll just quickly take you through all of these clauses, and then we can best understand all of those clauses by looking at the annexures. Because in the annexures, all of these details are captured, through which we will be able to identify the nature of transactions and how the auditor will be capturing all of those transactions during the course of his audit. First, particulars of each loan or deposit in an amount exceeding the limit specified in section 269 SS, taken or accepted during the previous year. Okay. So this is about taken or accepted during the previous year. Now there are various particulars for this. Name, address, PAN number of the lender or depositor, means who has given this. Amount of loan or deposit taken or accepted. Okay. Whether the loan or deposit was squared up during the previous year. Maximum amount outstanding in the account at any time during the previous year. Whether the loan or deposit was taken or accepted by check or bank draft or use of electronic clearing system through a bank account. In case the loan or deposit was taken or accepted by a bank or by a bank draft or check, whether the same was taken or accepted by an account pay check or an account pay bank draft. Okay. Now in this case, let's move on to Annexure 11 to understand all of these requirements as to how those have been captured. And these requirements are too many, so I'll just show you this in parts. So this requires loans or deposits taken or accepted. So if these are loans or deposits taken or accepted, what's the first step to capture it? Go to the liabilities, because all of these amounts will be appearing in the liabilities in the books of accounts. So that will become the basis for identifying all of these items, for capturing all of these items. Okay. Now, in respect of those loans or deposits, various particulars are required to be given. So that's why at times, and this is particularly for the listed companies who accept all of these deposits and wherein all of these limits, etc., are allowed for their acceptance. At times, this data can become quite voluminous. It's not necessary. At times, it may happen. So that's why capturing of this complete data is not only important, but the data which has been captured in terms of its particulars are very important. Which means if we have to specify the amount which is taken or accepted, we can very easily check it. So this column number E is for what? Amount of loan or deposit taken or accepted during the previous year. So we will go to the total at the end. So if we go to the total at the end, we will get the total of all loan or deposit taken or accepted during the previous year. And this can also be traced to the books of accounts. But if you'll see, there are 82 line items over here. There are 82 line items. And for 82 line items, name of the lender or depositor is required to be captured. Its address its PAN number, its amount which is taken, then whether the loan or deposit was squared off during the previous year. Squared off means loan was taken during the previous year and was repaid during the previous year. So even that transaction will get reported. So it's not that only the closing balance will come. Even if it was taken and repaid, it will come. Then the closing balance will come. Then the maximum amount which remained outstanding. So let's suppose during the previous year, up to a particular point of time, this amount touched, let's suppose 85,000 for this party. So 85,000 will come. Its closing balance may not be 85,000. It may be only 25. It may be 5,000. So 85,000. So that means the maximum amount which touched will be required to be reported. So which will require scrutiny of the ledger of each and every party. Correct? Because only then the management will be able to report all of these balances, or maybe some of the reports to the systems will have to be generated to capture all of these data. Yeah. Then the next step will be whether the loan or deposit was taken or accepted by check or bank draft or use of electronic clearing system through a bank account. Yeah. So if it's a check, it will be reported as a check. If it's a bank draft, it will be reported as a bank draft. Or if this is something in the nature of RTGS or NEFT, that will also be specified. So that means again the particulars are required to be reported. If it's a check and an account pay check, then it will have to be specified, yes, it's an account pay check. And for which I told you it's not easy for the auditors to track, because account pay checks will not be in the possession of the company. That would have been deposited. So that's why for this point, the auditor will always give a representation that this is based on the representations from the management that all of these checks happen to be the account pay checks only. Now, looking at this data, I hope you will all understand that capturing of this data is not easy. And there are chances of making mistakes. Now, what sort of mistakes are possible? Let's understand. The name may go wrong. Its address may be wrong. The PAN number of the party which is reported over here may be wrong. Yeah. So all of these mistakes are possible because these are all manual data. Now, in respect of all of these information which is getting captured over here, once again, it's not the duty of the auditor to check each and every information. Auditor will again test check this. And if you can see, this data is only running into 82 line items. It may be running into, let's suppose, say 150 to 200 line items, or maybe say 500 to 600 line items at times, depending on the transactions the company may have had during the previous year. So that's where this data checking again is more of clerical and voluminous, and that's why this is something which will require sample testing on the part of the auditor, wherein he cannot get into the testing of each and every item. Clear? Yeah. But of course, one check for the auditor will be to ensure completeness, and that will be possible by comparing the balances in the books of accounts and the amounts which would have been reported under this clause. Clear? Yeah. Now, similar to this, there are many other clauses. So I'll just flip through those clauses now. And I'm just hoping through that you will get the perspective around every clause. Now for 31A, we discussed that particulars of each loan or deposit in an amount exceeding the limit taken or accepted is required to be reported. Okay, so let's see what will get covered under 31B. 31B says particulars of each specified sum. It doesn't say loan or deposit. Means any amount other than loan or deposit, because loan or deposit will go under A. Anything other than loan or deposit will come over here, which is exceeding the limit as per 269 SS taken or accepted during the year. Means any amount taken or accepted during the year other than loan or deposit accepted during the year will come under this clause. And under this clause, again, all those particulars will have to be reported. Clear? Similarly, the audit procedures around this will also be same. The starting point for this again will be the liabilities. BA. So what is there in BA? Particulars of each receipt in an amount exceeding the limit specified in 269 ST. Now it's a different section. 269 ST in aggregate from a person in a day, or in respect of a single transaction, or in respect of transactions relating to one event or occasion from a person during the previous year, where such receipt is otherwise than by a check or bank draft or use of electronic clearing system through a bank account. Therein again, all of these particulars are required to be reported. Similarly, we can go to BB and BC. So you can understand now, all of these are very much on line of what we discussed in B. So let's understand what is there in BB. Particulars of each receipt in an amount exceeding the limit specified in section 269 ST in aggregate from a person in a day, or in respect of a single transaction, or in respect of transactions relating to one event or occasion from a person, received by a check or bank draft, not being an account paid check or an account paid bank draft during the previous year. Once again, we have the particulars which are in line with what we have discussed. And moving on to BC and BD in the similar way. So let's read the requirements of BC. Particulars of each payment. So in BA and BB, we understood this was particulars of each receipt. Now we are talking about particulars of each payment. So it says particulars of each payment made in an amount exceeding the limit specified in same section 269 ST. And all of those things remain same. Okay. Similarly, if you go to BD, it also talks about particulars of each payment made in an amount exceeding the limit specified in section 269 ST, and all other points then remain on the same lines. Then moving on to point number C. Particulars of each repayment of loan. So in the initial part, when we were looking at A, when we were looking at B, so it talked about loan or deposit taken or accepted. Remember, any such amount which is specified other than loan or deposit taken or accepted during the year. Now we are talking about each repayment of loan or deposit, or any specified amount advance in an amount exceeding the limit specified in 269 ST. With the same particulars will get reported over here. Similarly, if you look at point number D, it talks about particulars of each repayment. This also talks about particulars of repayment of loan or deposit or any specified amount which is exceeding the limit specified in section 269 ST. Okay. Now, if you move on to point number E, it talks about particulars of repayment of loan or deposit or any specified advance in an amount which is exceeding the limit specified in section 269 T, which is received by a check or a bank draft, which is not an account paid check or account paid bank draft during the previous year. Yeah. So now for all of these details, you would have understood that the requirements in terms of the particulars, etc., which are required to be captured over there was very much on the similar lines. And for the auditor to report on all of these matters, generally what you'll see is that the management will have system generated reports these days. The systems the management will be using will be capturing most of these data, which will get reported in Form 3CD. Okay. The auditor would therefore require, first of all, tracing of the amounts to the books of accounts to ensure completeness, because First and foremost is the completeness. If the completeness is ensured, then it only comes down to the accuracy of the particulars or the details of the particulars, whether particulars which are reported over there are correct or not, which has to be on test check basis, because as we have discussed, a lot of particulars are required to be furnished over here, and all of those particulars may not be correct. Yeah, so that's why for them checking is important, but the checking again cannot be 100%. Checking has to be on test check basis. All right. Yeah. So with this, we come to an end to our discussion on this tax audit for today. And we are still left with some part of this tax audit, and we are still left with some more examples to be discussed in respect of tax audit, which will continue in our next session. And in the next session, we'll also be starting on the GST audit. So hopefully we should be able to conclude both of them along with some examples to practice more of these scenarios. All right. So with this, we can just end our discussion. Mahesh has a query. He's asking, sir, to certain SS says loan or deposit other than account paid check, etc. So we are trying to report even account paid checks compulsorily or account paid checks compulsorily. Yes. That's why the particulars are required to be reported. Huh? You saw one column which I showed you, account paid checks, whether it's received through account paid check or not. So it's required to be reported. Okay, then I think some of your queries during the day have been around the recorded videos. So those will be available to you. I understand the process is on, and the videos are getting uploaded. So very soon you will be able to access it. There's some technical glitch at the end, and which will hopefully get resolved very soon. Yeah. So with this, we can just end our discussion now. And I would request all of you to make sure that you revise all of this stuff of today and of the previous session. And when we meet next, we'll practice question based on all the parts of the tax audit that we have discussed so far. Okay. Thanks for your time.